Hello, everyone. My name is Zulfiqar, and welcome to another episode of Income Investors. With me today is John Whitefoot with another exciting income pick. The outlook for real estate investment trusts, or REITs for shorts, like today's income pick, Office Properties Income Trust, traded on Nasdaq under symbol OPI, has recently taken a bullish run. Since March 2022, the Fed has raised its interest rates by 11 times. This is bad for REITs because higher interest rates make it more expensive to borrow and service their debt. It also weighs on their profitability. On the plus side, higher inflation increases their property's value, though that's not something investors can sink their teeth into. What investors have come to appreciate, though, is that Fed is taking a pause on its key interest rate hikes, which it did in early November and did it again in December. If you look closely, it also hinted that there could be rate cuts coming in 2024. With the US expected to avoid a recession, investors are also optimistic that the Fed will begin cutting interest rates in spring of 2024. And this is helping juice REIT stocks. Office Properties Income Trust is no exception. John?
Yeah, thanks, Mo. Office Properties Trust used to be called Government Properties Income Trust, and that should kind of give you a good idea as to who its biggest tenant is. OPI currently owns and leases 154 properties with approximately, I think it's 20.7 million square feet, located in 30 states and Washington, D.C. The company's occupancy rate is pretty high at 93.3%, which continues to outperform the broader market. As of this recording, approximately 64% of office properties revenues were from investment grade tenants. The U.S. government is its biggest tenant, responsible for 20% of revenue. Alphabet, or Google, is a distant second at 4.2%.
How did it do in the third quarter of this year?
The REIT's normalized funds from operation exceeded the top end of guidance at $49.4 million, or $1.02 per share. Cash available for distribution was $17.3 million, or 36 cents per share. It ended the third quarter with cash and cash equivalents of $24.3 million. We also had something like, I think, $550 million available to borrow under its revolving credit facility for total liquidity of $574.3 million. Leasing across the company's portfolio remains active, with 586,000 square feet of new renewal leasing in the quarter, and now totals more than 1.5 million square feet year to date. Now, during the quarter, the company also sold one property containing 80,000 rentable square feet for, I think, 10.5 million. And since the end of the third quarter, it's entered into an agreement to sell two properties for an aggregate price of 21.3 million.
Let's talk a little bit about its dividend as well.
Well, for the third quarter, the company's board declared a quarterly cash distribution of 25 cents for a current yield of pretty whopping yield of 20.73%. Now it's cash available for distribution of 36 cents per share can safely cover that payout, while OPI has reliably paid a quarterly dividend every quarter since going public in 2009. It has both raised and lowered that payout, though of particular note, it's raised it more often than not. It last raised its payout in 2019, but reduced it this past April from 55 cents to 25 cents per unit, which is a pretty big cut. But the cut came around the same time it announced plans to merge with Diversified Healthcare Trust. Reducing its dividend was expected to increase financial flexibility for office properties through the closing of the transaction. But this past September, it actually announced that it was terminating that agreement. Nothing is certain, of course, but hopefully with the merger in the rearview mirror, office properties decide to start raising its quarterly payouts again.
And that reliable payout can help provide dividend hogs with a safety net and help them ride out the ongoing market volatility. And while it's been a rough ride for office REIT industry in general, OPI stock has begun to rebound.
Yeah, as of this recording, office property income stock is down 48% year to date. But on the plus side, it's also up 25% over the last month and 10% over the last 3 months. And Wall Street is increasingly bullish on office property stock, with an average 12-month share price target of $12 to $17 per share.
John, thank you so much for your analysis. Just to recap, investor punished REITs during pandemic and since the Fed started to raise its interest rates to highest level in 22 years. That's because they thought tenant would not be able to pay their rent, which would cut into their profitability. Thanks to office properties' rock-solid tenant base, it was able to weather the pandemic and interest rate cycle better than the most. First, 64% of OPI's revenues were from investment grade rated tenants. Second, the US government accounts for 20% of total annualized rent. And third, REITs are able to offset inflationary pressures through built-in rent escalations. All of this allowed Office Properties Income Trust to maintain a reliable cash flow and provide investors an ultra-high yield dividend payout. That's it for today, and make sure to go to incomeinvestors.com to get our free special report on our top 3 income stocks to own today. One of those stocks currently has a dividend yield of 12.7%. You can find the link to incomeinvestors.com in the description below. We'll be back with more videos soon, so stay tuned. In the meantime, don't forget to like this video and subscribe to our channel. Goodbye for now.